Futures are up again, 30 minutes until the start of the cash trade after an incredible reversal yesterday. I'm Matt Miller.
I'm Danny Berger. Will it last? Bloomberg open interest starts right now.
Yesterday's Nvidia-led rally proved to be short-lived, with stocks set for another day of choppy trading as crypto collapses.
The doves say their part and help a rally this morning. John Williams reignites bets for December rate cut, while Stephen Myron reiterates his dovish view.
And the Gap rounds out a busy week of retail results, posting strong sales in a tough consumer environment. The CEO, Richard Dickson, joins us later this hour.
I know Gap is small, but I kind of feel like it's this ironic thing where retail is doing well and tech isn't doing well. It's like the opposite of what we've had all year.
But lower levels, though, right?
Yes.
It's consumers maybe trading down.
Yeah,
the problem.
That is fair, and that is a problem. Now, when it comes to tech, Nvidia did start the pre-market session lower. It is higher now, 0.7% or thereabouts. Yesterday's meltdown across the board of Nvidia hurt the entirety of the equity market. Shares fell 8% intraday, eventually closing 3% in the red, Matt. For the entirety of the stock market, it gapped up 1.5%, ended down 1.5%. That's only happened 4 times in the entirety of American equity history.
Yeah, it's incredible volatility, the likes of which we really haven't seen since the Liberation Day action. Check out MicroStrategy right now. Not a huge company. Okay, it's 6 times larger than the Gap, but the point here is that all of these Bitcoin treasury companies, which have flourished over the past few quarters, are down on Bitcoin, posting its worst monthly performance since 2022. And the total crypto market is down more than $1 trillion since October highs. Maybe not in terms of absolute size, such an important marker, but in terms of animal spirits, Danny, this really explains a lot.
Yeah, and again, Bitcoin down 4% this morning. Let's get more on the market volatility. Joining us around the desk is Bloomberg macro strategist Michael Ball and Bloomberg tech co-host Caroline Hyde. There's maybe 2 parts to this. One is just how weak the positioning is and how weak the hands are. The other is maybe it doesn't matter about CapEx projections and letters of intent, that what matters is the ability to finance some of that organically or through the debt markets, Caroline. Is that the narrative that reared its head midday yesterday?
Yeah, it felt as though there was a desire to just get more bearish. And the way in which they're playing the bearishness is looking at companies like Oracle and CoreWeave. Look, no one's starting to say that Amazon, that Microsoft, that Alphabet aren't good for perhaps issuing a little bit of debt for the first time in a long while, and yes, probably still financing a lot of the capital expenditure through their own cash flows. When you're looking at a company like Oracle that comes out and does $18 billion of debt, and it is a more leveraged company, you start to wonder, okay, what are the long-term horizons of this company? It is going to go into negative free cash flow to a significant extent by 2028 in particular. How are they going to continue to finance the data center continuations, particularly when we've had all the narrative around Blue Owl this week? Are they still going to be financing partners of choice? And ultimately, where is the return on all of this? And I think that's the key question for many. We're even seeing Oracle's CDS, of course, credit default swaps. That's the key hedge many are using. Look, no one's saying Oracle's about to default in any way, but maybe its credit rating profile does weaken a little bit, and maybe you do play at CDS to be able to hedge the rest of your positions if indeed this AI bubble thesis does play out.
Yeah, and they've got over $100 billion in debt. As you say, that's pretty substantial compared to their $600 billion market cap. It's not like, you know, when the Mag 7, when the other Mag 7, which are trillions of dollars in market cap, borrow like 20 billion in bonds. The other thing is, speaking of borrowing, the Fed, right, that happened yesterday. By the way, here's Oracle's DDIS, so you can see how much they owe, and one fantastic function on the Bloomberg DDIS Go. The other thing that happened yesterday, obviously, was the jobs number, which Michael Ball, I know it's late, and we could expect to see chop there as well because of the government shutdown. But with jobs more than double the expectation, adding 119,000, it's really difficult for the doves to make the argument that we need another rate cut.
Yeah, it was a frustrating report. One, obviously, it's lagged, so we have to put that in context. But the household survey was significantly weaker in a lot of ways. We didn't have a lot of cyclical job builds. There was a better breadth. Unemployment rate creeped up. It was actually getting close to 4.5 on a rounding basis. And then, you know, overall, it didn't really align with this high NFP. So you had something for everyone again, which keeps the debate going. Where are the hawks going to be? Where are the doves going to be? There's no kind of coming together on consensus. And You're seeing that again today. A lot of Fed speakers, only a couple touching on policy and economic outlook, but Williams clearly moving the tape earlier. The market's looking for some sort of sign that at least it's going to be 50-50 into December. Until then, we're going to have a higher vol regime cross-asset.
Well, I mean, a higher vol we've gotten, but my kind of the frustrating thing is that by this time yesterday, we knew all of this. We knew all of that. We knew all these concerns. Nothing changed. How much of this is just about positioning that's been built up that's extremely weak in terms of the ability to hold on?
Yeah, we were watching this level that systematic CTA selling would come in. We've already seen vol control guys, and these are big money. These are billions of flows that come and go based on sort of the dynamics of volatility and levels and trend. We were watching this last cohort, the CTAs, kind of sitting right at a trigger point where they would probably unload a lot. Come yesterday, tape falls under its own weight. No real headlines. We're searching for that first hour around 10:30, and behold, CTA guys are the kind of notorious sellers that kind of got put buying going, and all of a sudden dealers hedging is driving it lower and lower, and we go through the 100-day moving average, we go through the October low, and we're sitting now at a point that's much weaker.
It would be interesting, and I love all of your take here, but I wonder if it was ultimately the market trying to find a narrative. And as you say, technically we were under some pressure. There's now all this lip service being paid to accounts receivable on Nvidia. There's a lot of suddenly searching within the fundamental details of what we've got of Nvidia. Why would anyone be selling it? People now clutching at straws that maybe it still owed a lot of money by its customers. It still got a lot of inventory. Are the people good for the money? Is ultimately the $500 billion that Jensen Huang is talking about really in the bag? But that did feel like something that people searched for after the fall rather than as we precipitated it.
By the way, in that entire narrative that's really been bubbling up over the past week, I feel like one of the things it coincides with are the hawks from the Fed coming out. It's like the hawks coming out gave allowance to this market to not only talk about that narrative, but to put it into action.
Yeah, we had a ton of hawkish Fed speakers yesterday coming out. Beth Hammack before the jobs number. We had Michael Barr after saying not only that you know, we don't necessarily need a cut right now because that would prolong inflation, but also that I think Michael Barr said AI was going to substantially boost GDP growth. So we're looking at stronger growth, not a weak labor market. Why would the Fed cut? I mean, it's not exactly, it doesn't feel constrictive at all.
Yeah, and I would actually add Governor Cook probably made a big impact because she kind of left the lanes and talked about some of this credit concerns Carolyn just highlighted with Blue Owl and some of the more cockroachy stories that have been making their rounds for the last few weeks. And that's kind of not really where the Fed often goes. So that caught a lot of people off guard. But to your point, yeah, we have guys that think things are okay still. Yet the market is sniffing out weakness in many parts, including the consumer and labor, but also on the balance sheets of the drivers of growth, the AI complex.
I wonder what you and Ed Ludlow are hearing on your program, Bloomberg Tech, about this private credit drama that we're seeing. It's not really a blow up yet, right? There was a bump in the road for Blue Owl, and their stock's been doing horribly. But this is a huge part of the financing for all of the data center build out.
It's getting creative, and they had to get creative because so much money is needed. Isn't it weird that a month ago, whenever a company announced that they were raising their capital expenditure, they were going to be increasing these data centers, when they were going to be exchanging their own equity to finance and get involved with a future purchaser of their chips, like we did with AMD, we applauded it. We sent the shares higher.
Well, some of us were skeptical.
Yeah,
some of us were skeptical.
Little Matt Miller in the corner was there being skeptical. Michael Burry today adding fuel to the fire, saying, who is the accountant, basically, or an auditor of OpenAI? There is a lot that's happening in the private markets. That this is where media and this is where deep data analysis comes in of bringing transparency to the fore. That's what everyone wants to start seeing.
But it's still ringing in my head. I was speaking with a top executive at one of the very, very big private capital shops who said, we are not taking AI risk. We are taking Oracle credit risk. What happens when Oracle credit risk no longer looks attractive? I know the CDS is still at normal and historical levels, but what happens if it blows out more?
That's very closely related to the question of who is the accountant, you know? And don't forget that Larry Summers was on their board until Wednesday.
But let's face it, Sarah Friar is a very strong pair of hands on Chief Financial Officer. I'm sure that they are crossing their T's, dotting their I's, but I'm sure some questions are coming their way to the representatives over there.
All right, thanks for the reassurance, Carolyn Hyde there. Michael Ball here writes for the Bloomberg MLive team. You can get his work by typing MLIV Go on your Bloomberg terminal, and you can check out Caroline and Ed's show coming up at 11. Right now, check on what's going on in futures. We are in the green after the huge reversal that we saw yesterday and the drop below the 50-day and the 100-day moving average. We're still We're still down there this morning. Let's get a look at some of the other movers on the radar. Danny, what do you see in terms of single stock
So there's
stories?
Netflix, Comcast, and Paramount. They've all made their bids for Warner Brothers Discovery assets. Not moving things hugely here, but I guess the important thing is that they're all still in this. Comcast and Netflix, they're more interested in the film and TV library. Paramount, for their part, said that they would buy the whole shebang, including cable channels.
All right, Eli Lilly and Novo Nordisk plan to sell their obesity shots directly to employers through Waltz Health, bypassing traditional middlemen and women while helping companies avoid rebates and fees. And I think it's a fascinating approach to lowering healthcare costs.
Yeah, I mean, companies presumably would love that, to have a very healthy workforce. Let's just wrap things up. Gap, they beat estimates for the third quarter. They saw an uptick in high-income shoppers. So what's good for Gap, maybe not good for the economy. CEO Richard Dickson will join the show later this hour with those shares up 8 1/3%. You're watching Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. Washington is threatening to halt intelligence and weapons shipments to Ukraine in order to force the country to accept a U.S. brokered peace framework with Russia by next week. This is according to Reuters. But Germany, France, and the UK are aligned with Ukraine's President Zelensky, rejecting key terms that would in the U.S. brokered deal that would hand Putin major territorial gains. It's a big story, complicated, and still in its early days. So we'll continue to report on that. New York Fed President John Williams said there is still room for the Fed to cut rates again soon as the job market cools and inflation risks fade.
I view monetary policy as being modestly restrictive, although somewhat less so than before our recent actions. Therefore, I still see room for a further adjustment in the near term to the target range for the federal funds rate to move the stance of policy closer to the range of neutral, thereby maintaining the balance between the achievement of our two goals.
So that's dovish. And speaking of doves, last hour, Fed Governor Stephen Miron joined Bloomberg Television. He had this to say about the recent lack of government data.
The lack of data doesn't mean that we don't have a forecast. We did have a forecast. All it gives us is opportunities to falsify our forecast. And there hasn't been anything in the data, in the news, in media stories, in private sector data, alternative data that's available to us, that would make us think that the forecast is somehow nullified and there's been a big shock to it. So if anything, all the information that we've got in the interim since September FOMC has inclined to the dovish side.
So the doves today, but don't forget, yesterday, the hawks, right? We had Hammock saying that another cut would risk prolonging inflation. We had Barr saying that AI was going to boost GDP. And then we had Cook saying, watch out for these private credit issues. Why are we looking at this? Well, NBA superstar Steph Curry is officially a sneaker-free agent, and he wasted no time making a statement. Just one day after parting ways with Under Armour, Curry warmed up for a game in Nike sneakers. The split with Under Armour ends a decade-long partnership that never lived up to its hype. Curry is now expected to field offers from Nike, Adidas, and other brands, with the sneaker world on watch for his next move. But this just goes to show, Danny, that it doesn't really matter what sneakers he's wearing. The guy is great at playing basketball. It's not about the shoes.
Well, you know, there's some lore behind this. Apparently, like, back when this deal was first being negotiated, Nike lost out because they mispronounced his name. A representative did and called him Steven instead of Stephen Curry. So apparently that's why Nike lost out. So maybe he's gotten over that.
All of that is why he went with Under Armour. Not because the shoes make him a better player.
Apparently that's like part of the lore. I don't know how true that actually is. I think his dad, Curry's dad, might have said that in an interview to someone, that was part of the reason they didn't go with Nike.
Well, I wouldn't make that mistake.
I know you would. All right, let's get a check on futures ahead of the opening bell, because we have seen a reversal of some of the worst of the sentiment yesterday, mostly having to do with Williams, as Matt was saying, a very influential Fed member talking about a cut. But it was a really, really ugly day yesterday, and let's discuss the market mechanics of that. Bloomberg's equity team leader, Elena Popina, joins us now. Can we just talk about the reversal? Because it was so odd to see a really strong open and then an ending to that degree. Just how does it stack up with history in terms of the move?
It's not even odd, it's very rare. You know,
Right.
We had a very big gap at the open, and then we immediately reversed that an hour into the session to plunge, more than 1% at the close. To Goldman's data, such a reversal happened just 2 other times ever. If you slice and dice the data, there is a lot of concern about how quick that reversal happened. And, there were just, a few other times this year when such a big drawdown took place. The last one, April 2025, the depth of the, tariff-related sell-off.
Right, the Liberation Day volatility. So what we saw yesterday is called in technical terms a bearish engulfing
God,
pattern.
that sounds bad.
It sounds bad, and it's a pretty sure sign if you look back at the history of sellers taking over the market.
Yeah, we breached below the 65.50 level. That was the intraday low of October 10th. And after that happened, all sell-off started to accelerate in the riskiest parts of the market. The micro caps hit a 10% correction. They reached an all-time high just 2 weeks ago. So the high leverage, high beta stocks posted, 5% decline, biggest sell-off in a couple of months. So quite a lot of concern about, number one, the over-leverage in some of the riskiest parts of the market. And second concern is, of course, Bitcoin and what's happening there. A few critical support lines were breached.
To that point, does some of what we see suggest that a lot of this was either forced selling or systematic that took over because of, again, some of the levels that you're looking at?
Yeah, prior to that, the leverage was at 2x beta. So it's a lot of leverage in some of the riskiest parts of the market. The year end is approaching, and some of those funds have to close out their books and have to unlever some of their positions. So we saw some of that yesterday. We saw some of that earlier this month. But the longer term story is there is more risk to be unwound from current levels.
And, Elena, we've noticed on this program that lately it seems like we'll start in the green, and then by the time we get into our 10 o'clock hour, I don't know if it's something...
You're too bearish, Matt. I think that's the problem.
But there's a sell-off, like around 10:30, 11 o'clock, and it seems to be happening pretty regularly. Why is that?
Yeah, part of that has to do with the way the leverage funds work and the way they just kind of restructure it around that time. Part of that is it's still a mystery, but Europe has something to do with that because Europeans close out their books for the day. They don't want excessive risk now that the markets in the U.S. continue to trade. So they just sell now and ask questions later.
Europe. Wow.
All right, Elena, thanks so much for joining us. Elena Popina runs our equities team on the BN side of the building. Coming up, where do investors find safety in equity markets right now? Where can you hedge? We'll ask Emily Roland of Manulife, John Hancock next. This is Open Interest.
This just coming in from Scott Rubner of Citadel saying these mechanical outflows are likely to stay heavy over the next few days and then fade away completely. He says we're in the 8th inning of a 9-inning momentum unwind. Underscoring that was the wildest trading day of the year yesterday. Nvidia earnings, a mixed jobs report testing dip buyers later in the trading session. Our next guest, Manulife John Hancock's Emily Roland, suggests investors quote, using more mid-cap allocations to reduce the valuation risk headwind. Emily Roland joins us now. Emily, yesterday was a day where if you were someone who was like, I'm not in AI, I'm in other sectors, I'm hedging my exposure, you would have faced small caps dropping nearly 2%, an equal-weighted S&P dropping more than 1%. On days like yesterday, is there anywhere truly to hide out?
Danny, bonds. We've been talking about the power of the income that's available in high quality bonds and the fact that they're really mispriced based on the macro environment. Investors haven't cared much about what's going on from a macro perspective, but the data haven't been great. The jobs report yesterday, for example, yes, 119,000 new jobs added, but we now have 2 negative months of jobs growth for June and August, and that has not happened outside of a recession since 1996. So the labor market to us not looking great. Bonds still aren't sniffing it out. And on days like yesterday where high quality fixed income held in, to us, that's the place to be.
You know, we have this function, Emily, on the Bloomberg terminal, TLTS Go, tilts, and it shows the factors of stocks or funds. compared to an index. This is the Sachs ETF, the semiconductor ETF, and you can see compared to the S&P 500, the volatility is off the charts. Why is this semiconductor index, which is, you know, I guess the most important picks and shovels of the AI gold rush, so volatile?
Yeah, I mean, there's obviously a valuation issue there. We have a love-hate relationship with these stocks. We love them because they have the best earnings growth prospects of any stocks globally. But the other side of the equation is that they've been overloved, they're overbought, and they're overconcentrated. So this is the pocket of the market that is most ripe for potential downside volatility here because they're trading at such elevated valuations. And it's a key reason. We've been there because of the earnings growth potential, but we have been diversifying and owning things that are on sale. It is really hard in this market to find things that are on sale, but U.S. mid-cap stocks are trading at a 30% discount to their large cap counterparts. That's the steepest discount since the late 1990s. So we've really been thinking about that as a way to diversify, get a totally different sector composition. In mid caps, you have more industrials, which I would say are also a beneficiary of the pick and shovel element of the AI investment here. You get things like banks, which we're seeing some M&A activity within mid cap banks right now. So it's really sort of your anti-tech, anti-AI exposure there to really complement that overall.
All right, Emily, you're going to stick with us through the market open as we watch futures rise today. A little bit of a rebound from the incredible reversal yesterday. We were up 2% and we gapped higher at the open and then down almost 2% at the close. Nvidia was up 5% and then fell 3%. We'll see how this trade works out. This is Bloomberg. All right, we're up today, but how long will it hold? Moments until the opening bell. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures are showing some sizable green arrows, 0.4% on the S&P, at least substantial. NASDAQ up 0.33%. Russell 2000, the small caps gaining about 0.5%. But we've been seeing this pattern where we build up at the open, and then a couple hours into the session, sell-off. Scott Rubner at Citadel says this is part of a mechanical deleveraging that's going to happen over the next few sessions, but then should stop. Fidelity ringing the opening bell, and Cynthia Low-Bessett there doing the ringing herself. She is the head of digital asset investing. So I don't know if this is the day to be doing that, since the bottom seems to be falling out of Bitcoin, but I'm sure there are other digital assets that Fidelity manages which are less volatile. Jack Henry ringing the opening bell, and I don't know which one is Jack.
Or Henry.
A fintech company. I assume that was one dude, but in terms of the stocks to watch, again, it's Nvidia, obviously the biggest concentration, the biggest company in the world. And we thought yesterday, the one that had assured us all everything was going to be okay.
Right. Yeah, that sound you heard yesterday was every journalist sprinting to their desk to erase that headline that was like Nvidia saves the day for markets. It was up 5%. It fell 3%. This morning, we are just barely holding on to gains. It is up 0.7%, about 0.75%. It did start the pre-market session negative. Williams speaking, saying that he would endorse something of a cut, is helping us out. But again, Matt, it has just been crazy volatility for Nvidia, which means crazy volatility for the entirety of this market.
Yeah, truly historic volatility. A check on MicroStrategy as Bitcoin is on track for its worst monthly performance since 2022. You can see that company, that stock is unchanged right now. MicroStrategy moving a little bit lower as the market opens. Yesterday, MicroStrategy was up 3% and then down 5%. So similar volatility, obviously a much smaller size. It's only a $50 billion company to Nvidia. Let's bring in Manulife, John Hancock, co-chief investment strategist, Emily Roland. And Emily, clearly crypto is still a kind of niche part of the market, even if Main Street is adopting it to some extent. Bitcoin is worth $1 2/3 trillion, though, so you can't really look away. And it represents animal spirits, I guess your risk aversion pretty well. What do you think about the fact that we've gone from 126 on Bitcoin down to 84 in like a month?
Yeah, we would say, Matt, don't get too sentimental about sentiment. And Bitcoin is the poster child for a sentiment indicator to us. We've been struggling for years to identify the value there. It doesn't have any income, it doesn't have any earnings. The only thing that drives it, in our view, is the price itself. And so you're seeing a lot of that unwound. This market in general in 2025 is one that's been very, very much driven by sentiment, technicals, momentum. And we all know how those trades work. If something goes up in parabolic fashion, it tends to come down in parabolic fashion. So because we are seeing a bit of an unwind in terms of some of those momentum winners, those technical titans of the year, whether it's, in the Kospi or whether it's in gold or in crypto, we're starting to see a little bit of that momentum coming out of the market here. So not totally.
Or the momentum stocks, right? Or the likes of Robinhood, for example, the unprofitable tech. Emily, does that mean when you're looking at something like crypto, again, this fear that maybe people are getting margin calls, they have to liquidate other momentum type stocks, that you now need to use crypto to understand where the rest of this risk market is going? And if that is somewhat the case, is it troubling that as the rest of this market bounces, that Bitcoin, you can see it there, is still down nearly 4% this morning?
Yeah, I think it's a really important point about how tied in a lot of these assets are with crypto markets. And I think watching generally, this morning we are seeing some dip buyers coming in. That's certainly the narrative that's pervading markets, and we'll see what happens around 10 or 10:30. But I also wanted to point out that the Fed speak that we've heard this morning may also be contributing to some of the sort of risk on bounce that we're seeing. Powell and other Fed members sort of spooked the markets. It's almost like they've tapped on the brakes a little bit, and the market's really jolted because of it. So you heard hawkish speak, of course, from Powell and then some other Fed members, some of that based on the lack of data amidst the government shutdown. But then John Williams comes in this morning and suggests that, that December rate cut's back on the table. So I think the markets have really been responding to this idea that the Fed's going to loosen financial conditions, even with inflation not back down to their 2% target, and a U.S. economy holding in okay. In a way, that's like the dream scenario for risk investors, is that the Fed is cutting into relatively stable economic growth. So you're seeing that narrative, I think, impacting markets this morning as well.
Well, we should point out that Nvidia just continues to plummet after the open.
It's falling a lot right now.
And we saw, we saw Nvidia rising, don't forget, just minutes ago, and gaining in the pre-market as well. And now we're looking at a 2 to 3% drop on Nvidia. So obviously we'll see the S&P do the same thing. Even, it seems, dovish Fed speakers can't do much to support this market. Why is that, Emily, that we've been seeing, a market open strong and then sell off in the first couple of hours, or in today's case, the first couple of minutes of the session over the last few sessions? It seems like there are over-leveraged PMs out there that are trying to unwind.
Yeah, it does feel like there's some sort of lower quality, over leveraged players out there. There's some systematic selling potentially going on. It's tough to identify here. But again, because we've seen such just breathtaking valuation expansion in some of these names, it's not surprising to see some of the froth being left out here. I was having a conversation with an investor the other day who wanted to talk about investing in India. So there's a lot of interest in sort of EM ex-China. What about the Indian stock market? We had about a 30-minute conversation. Then I stopped and said, the entire Indian stock market is smaller than Nvidia. And it was just such a a moment of just recognition of how remarkable it is that now the top 10 stocks in the S&P 500 represent a record 43% of the index. That is a drop the mic moment in my view. So when we do see volatility in some of these names that have run a lot, Nvidia is an example of a high quality stock with great earnings growth, no doubt about it. But the challenge, of course, is the price. So I think there's some concern there for sure.
Emily, a lot of the superlatives that came out of yesterday, the reversal, was that it was the most violent since April, or the biggest sell-off since April. Back in April, the volatility that was wrought by Liberation Day and tariffs had the impact of scaring off these M&A and deal and IPO markets. Going into the year, everyone was so positive it would happen. Considering the volatility that we're getting now, do we need to take a second look at financials too? I know you like the sector, especially in mid-cap, but if we get this type of market volatility, does that again delay this M&A renaissance that so many people are hoping for?
I mean, it's still early. We're down less than 5% off of all-time highs, and we have had it so good since the height of Liberation Day back in April. This market has been so impermeable to weaker macro data, to some challenges. I mean, all you have to do is look overseas. It's unbelievable. European stocks, for example, are up over 30% on 2 to 3% earnings growth there. The economic data are struggling meaningfully. European financial stocks are up 40-some% this year, almost 50%. And meanwhile, U.S. banks are well behind that. So I think if you're looking for, areas to think about trimming, it might not necessarily be in the United States. It might be overseas. So I think we're sort of, we've had it great. We're having a little bit of volatility here, but I think it's too soon to declare that we're going to see another 20% drawdown in stocks.
All right, Emily, thanks very much for joining us. Manulife, John Hancock's Emily Roland talking to us at the beginning of what looks set to be a volatile session for stocks. Danny, I was just looking at MAGO, which is a function I've been using now for 25 years. It's fantastic. Click into the time series tab at the end there, and you can see that this M&A renaissance seems like it is currently happening. It's not something that can be called off, right? In Q3, we saw $1.6 trillion of announced deals, and that's the highest level that we've seen since the magical year of 2021.
But so much has happened in that quarter, right? First of all, you have today's sell-off. You have players like Blue Owl feeling stressed in their publicly listed stocks. You have, the little cockroaches popping up. You could say that those things are idiosyncratic, but we heard from Mark Rowan speaking at the New Economy Forum earlier this week, who said maybe it is time to reduce your risk a little bit. So can the M&A renaissance, it is here, can it continue at this pace if that's the environment we're living in? Yeah,
I think excellent question, and such an important universe to follow. Let's get a check on what's going on in stocks right now as we do see Nvidia fall. It's not holding us back from gains on the S&P 500. And look at that, Danny. Wow. The breadth to the upside is just extraordinary.
Well, thank goodness, because it's been really bad recently, right? To your point, we're 417 up, 84 down, so that's helping us. Google doing really well. Look at Alphabet shares leading the board as the rest of tech still wavers from yesterday. By the way, there have been absolutely rave reviews of Gemini. Maybe there's this idea that if you're going to be monetizing AI, that Google is ahead of the pack, because that is the big fear. So let's just go over and look at Nvidia. A sharp drop in shares over the past 5 minutes, really. The thing opened up to the upside. Futures were mostly higher, down 1.4%, followed by Broadcom and Oracle. Oracle continues to sell off, down 4 and 0.2%. Does that become the poster child of being able to fund the splurge of debt coming into market to fund AI? Let's look at the sectors this morning, too. It is the push-pull with tech and communication services because Google is doing so well. You see that leading the board at 1.8%. Followed by healthcare, consumer staples, materials. Gap is small, but Ross is even bigger, so staples are doing well. That was the only sector to end the day positive yesterday. Energy to the downside, utilities, infotech, so some of the kind of AI-related plays, Matt, those are still doing poorly this morning.
All right, very interesting market to watch, and we'll see how it pans out if those leveraged funds start to sell off in the next couple of hours. Coming up, The Gap faces consumer headwinds, but sees a rise in high-income shoppers in recent months. So are people trading down? This is Bloomberg Open Interest.
Nvidia might be falling here at the open, but the rest of this market is somehow holding up, not as strong as it was, but we are up about 0.25%. I guess thank Fed speak. Will that carry us through the session? Usually in about an hour's time is when stocks start to fall, so we'll see if that holds through. Let's look at some of the top calls this morning, the analyst action that we are watching. First up, T-Mobile. That gets downgraded at Oppenheimer. The analysts there say that after a decade of big subscriber gains, it's getting harder for the carrier to beat estimates. He warned that slowing industry growth and increasing competition could pressure T-Mobile to raise prices. Those shares down 1.6%. Telsey Advisor Group, they have cut Bath and Body Works after the retailer yesterday slashed its full-year outlook and rolled out a turnaround plan aimed at saving $250 million over 2 years. The CEO says the company will refocus on core products, scale back categories like men's grooming and hair care, which I didn't even know they had, but those shares are down 6% this morning. Finally, Gap gaining after stronger trends at Old Navy, Banana Republic, and its namesake brand. They all drove a big third quarter beat. Analysts at Morgan Stanley and Jefferies say that Gap's brand reinvention is clearly paying off, calling the results very strong, a sign that the turnaround might be sticking, Matt.
All right, for more on the Gap, we're joined by Bloomberg's managing editor for global business, Shelley Banjo. And let's talk first about the brand reinvention, because I had no idea. To me, the Gap is normcore, has been normcore, and always will be normcore. Is there something different that I don't know about?
Yeah, I mean, 90s is still a thing. They're really leaning into their element. You know, the new CEO, not so new anymore, but, you know, came in, reinvigorated the brand, said we're not going to be doing the same old stuff that we were doing. A whole bunch of celeb endorsements and, you know, collabs that they're working with, and just really shaking things up.
Is that sustainable, a brand? It feels like it's a brand now that's being built on collaborations and celebrity deals.
Yeah, I mean, that's basically what's getting people back in the door again. You know, people sort of forgot about the
But it feels like for every brand, it's like you need Sydney Sweeney. I think for Gap, I think Gwyneth Paltrow.
Gwyneth Paltrow and her daughter, they have like a, big sort of, you know, retro, like, you know, mother-daughter, nice, feels good heart.
I heard they were doing a collab with Apple, and I thought that meant the technology, the iPhone maker.
Different Apple.
It's Apple Paltrow, or Martin, or whatever her name is.
Yeah, I don't know which last name she has, but okay, so it's that.
Yeah.
You had American Eagle do really well because of Sydney Sweeney. Why doesn't every retailer just take a note of that book and be like, what celebrity can we find to do some cool collaboration with?
Yeah, I mean, that's been the thing going back in time. I mean, Target, you know, very much popularized that with like Isaac Mizrahi, like back in the day. Like, it's something that is a tried and true playbook, but you've got to keep that going. And that's the thing, is can you keep that momentum going? And celebrities don't want to team up with you just to make money. They need to they're only going to team up with you if they think it's cool.
So we've had great retail earnings, as Danny points out, as we're all worried about the collapse of the burst of the AI bubble. Walmart, Ross Stores, TJ Maxx, and the Gap. No value judgments, but these are lower end, lower price tag purchases. Are wealthy consumers stepping down to support these brands?
Yeah, I think they're looking for deals is what is happening. The discounts in general across the board have really dropped. A lot of that has to do with tariffs. There haven't been as many discounts as there had been in the past. These are places where people can still go hunting for good things, TJ Maxx in particular, but also, you know, Walmart's offering, you know, pre-owned Chanel bags on their online stores now. And so a lot of these folks can go to these places and get some of the stuff on discount.
I mean, but again, that's not great for the overall economy. If that's right, if
No,
like
exactly.
that's what's doing well.
Yeah,
it's good for them, but maybe a bad sign for everything else.
Yeah, and I mean, Gap, the retailers that reported this week stand out from the rest of them. So like before this week, we had restaurants and retail chains warning of, you know, bad signs ahead. Home Depot, Target was bad, Sweetgreen.
Chipotle, Shake
all of
Shack,
those,
yeah.
exactly. And so this week was a rare bright spot, I would say, and it shows that when these retailers really give people what they want, they can still stand
But
out.
okay, with the fast casual, all of them were doing poorly, but isn't it also a case that when things were a little bit better, so many competitors come in? I mean, you walk outside and there are so many different fast casual things to play with. Is this maybe also just a little bit of a return to the norm? And when we were in the really boom times, people just overdid it, and too many types of retailers, too many types of fast casual type of companies popped up, and there's just lots of competition.
Yeah, and now when there's so many people offering the exact same thing, you're really gonna start to winnow that choice offering. And so you're going to go to the ones that you want to go to, and the other ones, not everyone's going to win.
Shelley, thanks very much. Shelley Banjo covers corporates for us here at Bloomberg. Bloomberg's Lisa Abramowitz joins us now, and she is sitting down with the CEO of the Gap. Lisa?
Thank you so much, Matt. Yeah, we do have Richard Dickson, who is the CEO, the not-so-new Chief Executive Officer of Gap Incorporated since 2023. Great to see you, Richard. Thank you for being with us. I want to start You definitely were one of the winners this retail season with beats across the board, increasing your full year forecast. I'm wondering how much the key to success this season in retail is catering to wealthier investors who can spend more at a higher price point.
Well, first off, thank you. It's clear our strategy is working, and it is showing up in the momentum. And we're seeing that in the results. We've had consistent strength from our consumer behavior that we're winning, actually, with all income cohorts. When you look at the overall sales, comp up 5%. That's the 7th consecutive quarter of positive comps for us. Our leading brand, Old Navy, the largest brand, delivered an outstanding quarter. We were up 6%. Gap up 7%. Banana Republic up 4%. Gross margin exceeding expectations. So from an overall perspective, what we see and are proving is consistency in the context of our strategy and our playbook. As we look at consumers, we do see the consistency and strength with our customer behavior. And we've been winning with all income cohorts, as you can see from the differentiation in our portfolio. We saw equal growth across low, middle, and high. And while we're seeing, external data points to macro pressure, particularly on the lower income consumer, our customers are finding our price, our value, our style breaking through the competition. And ultimately, we're very excited to be winning in the marketplace, giving us a lot of confidence as we head into the holiday season.
Yeah, talking about the holiday season, how robust do you expect it to be? How is it coming along? And how much are consumers resilient even in the face of price increases?
Look, holidays come every year. We're off to a great start. We have great activations that are planned this holiday. In particular, I'm very excited about certain categories: denim, sleepwear, fleece. These look really strong. Our value proposition, our marketing executions. Hopefully, you've seen some of the creative. When you go online to our sites, we're well positioned to serve our customers wherever and however they choose to shop. We just, for example, Old Navy did a partnership with DoorDash, which provides convenience for tens of millions of users. Our stores are ready, our teams are fired up, and we're looking to a strong finish to the year.
So, Richard, I expect you actually coming on and dancing to Milkshake in the background, because I hear you talking about some of the cultural relevance, and I wonder how much the battle for cultural relevance has been front and center for you about that viral ad. How much are you looking to new partnerships, new types of advertising as a way to really drive Gap strategy?
Cultural relevance is a very important part of our playbook, and we talk about relevance with revenue. You can have relevance, but not revenue. And so the key to success is when you have relevance that drives revenue. And collaborations do help brand relevance. Now, it has to be the right collaboration and a win-win methodology, but it does do a really good job broadening its consumer base when it's done well, and continue the drumbeat between bigger and larger releases. So to stay in the cultural conversation, Gap brand has launched over 13 collaborations that continue to just drive excitement and surprise. But what I will say is that these are very precise. And as I said, need to be win-win and authentic to the customer. They do attract different audiences. And in the Cat's Eye case, we did an extraordinary job continuing to introduce and discover Gap to Gen Z, which has been a really exciting segment for us. We got 8 billion impressions, 500 million views for the Better in Denim campaign. It was literally a global takeover, and it's become one of the brand's most successful campaigns to date.
Yeah.
We drove incredible traffic and, of course, double-digit growth in denim.
I have to ask, Richard, was this a direct response to American Eagle's Sydney Sweeney ad?
Look, I think the fashion industry is proving creativity. And competitively, we love the fact that there's lots of different conversations around fashion, and particularly in denim. We are front and center with our strategies. We did a Better in Denim campaign that was specific to Gap, expressing our originality. And, to some extent, sometimes it's convenience and sometimes it's ironic. But I think in the context of the denim dialogue, we certainly had our fair share of goodwill. The
denim wars continue, Richard. We just have just about a minute left. I am curious, going forward, how much you are seeing sort of that tariff-related impact on pricing, how much has already been factored in, and how much going forward you expect to still have to pass through?
Well, I would first call out our team. We have done a great job with our mitigation plans, which we've shared many times. It's been focused and thoughtful, making adjustments to sourcing, manufacturing, our assortments, and many other actions. And all of those actions were designed for the reaction of our consumer to continue to have our value, quality, and style portrayed, which is most important. The third quarter tariff impact was 190 basis points, but that was in line with our expectations. And despite this, we actually exceeded our gross margin outlook, which was driven by top-line momentum, less discounting, better regular price sell-through. So we're going to continue to pursue our mitigation plans, but we remain focused, most importantly, style, quality, and value for our consumer.
Richard Dickson, wonderful to catch up with you. Thanks so much on the quarter. Wonderful to get your perspective. That was Gap CEO Richard Dickson. Matt, I'll send it back to you.
All right, Lisa, thanks very much. Bloomberg's Lisa Abramowitz, obviously, she anchors Bloomberg Surveillance, talking with Richard Dickson from The Gap. Coming up in the next hour, Joanne Shu of the University of Michigan will talk to us about the consumer. We get the final reading of their consumer sentiment. And then State Street's Marija Veitmane discusses the disappointment we've seen from value stocks. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Still looking at gains on stocks, but a little bit of volatility this morning.
Yeah, just barely. Nvidia has been going back and forth between gains and losses. We'll see what sticks.
All right, in terms of what we have coming up, the Nvidia-led rally proved to be short-lived. Stock set for another day of choppy trading as crypto collapses.
The Doves say their part. John Williams reignites bets for December rate cut, while Stephen Myron reiterates his dovish view.
And a shift in motion. Porsche has unveiled an electric version of its Cayenne SUV that's drawing the ire of social media.
Matt, some breaking news crossing through. The final numbers for Michigan sentiment coming in at 51. That is slightly better than the prelim. It was 50.3. The expectations index, that's also better than originally recorded. It was at 49, now at 51. But for what it's worth, that 51 is still at a record low, and inflation expectations come in a little bit too, Matt. So the read on this, a little bit better than the preliminary numbers, but still not great.
Right, and the bottom line is we're looking at a middle class and, the lower earners that are struggling with inflation that just continues from what we saw, the relentlessly high numbers under the Biden administration, not there, but still not nearly down to the Fed's level. Let's talk to Joanne Shu about this. University of Michigan surveys of consumers director. Joanne, what is happening in terms of this disappointment? Like, why are we at these record lows? Is it all about higher prices?
It's really about cost of living and affordability. That's what the consumers are telling us very loud and clear throughout the interviews. Consumers remain very frustrated by the persistence of high prices. But what's new in this year is that consumers have definitely perceived that labor markets are weakening. We had a surge in the share of consumers spontaneously telling us that weakening incomes now were dragging down their personal finances. And we also have weakening labor market expectations going forward. We have over 2/3 of consumers expecting unemployment rates to rise in the year ahead.
Joanne, how will that differ when it's the start of 2026? Let's say the employment picture stays the same as is, that is low firing, low hiring, but all of a sudden we get tax rebates, we get maybe $2,000 checks as a tariff refund. What would that do to a consumer at this moment? Is this a consumer that has a higher propensity to save or to spend it?
Right now, consumers perceive quite a bit of weakness in the economy. And certainly if they were to get any extra cash in their pocketbooks, they would absolutely welcome it. But when that cash runs out, if the situation hasn't materially changed, they will continue to be frustrated about high prices. Now, consumers, a few months ago were expecting very much a worst case scenario to come after the implementation or after the initial announcement of the major tariffs in April. That hasn't come to pass, but consumers are still wary. They're still worried that things are going to get worse before they get better.
You see a split, right? Your microcuts show middle-income households reporting worse finances. Affluent cohorts are riding market gains. What specifically is a problem here? Is it food at home, that cost that's too high? Is it auto insurance or auto repairs, that cost that's too high? Rent or mortgage that's too high? What are they looking at?
Honestly, it's all of the above. It's going to be different things for different consumers. Consumers, when we ask them about their buying intentions, or is it a good time to buy a big ticket item, say a car or durable goods for your house, overwhelmingly, consumers are pointing at high prices. Many are also pointing at high borrowing costs. That has ticked down just a touch after the most recent rate cut, but not by a ton. When it comes to the pain of high prices, different consumers are mentioning different things. We're seeing references to food. We're seeing some references to insurance, housing costs, all of the above. Unfortunately, consumers are just frustrated across the board with high prices.
I'm just trying to understand if there were one thing that could change or improve sentiment, what would it be?
I think that one thing that could be a major wild card is if tariff policies were rolled back. If one of the things that continues to worry consumers, we have over half of consumers spontaneously citing, giving us comments about tariffs. Tariff rhetoric developments have obviously calmed down quite a bit since April and May, but consumers are still wary and apprehensive about the idea that inflation could rise in the future as a consequence of these tariffs. If these tariffs were to disappear or to be permanently adjusted to a lower level than they are now, that is something that could very well shape consumer beliefs about the future.
Joanna, when it comes to this consumer, Matt and I have talked a lot this year about the record level of ownership of households to U.S. equities. Historically speaking, what is the sensitivity of this consumer right now to what's happening in markets, especially if we get more days like yesterday where stocks have some real momentum to the downside?
In spite of the fact that that American consumers are increasingly participating in stock markets, as it turns out, these short-term movements in stock markets really only affect those with large portfolio exposures. Midway through the month, at the beginning of November, the consumers with the largest third of stock holdings were the only demographic group to see an increase in sentiment. And over the 2 weeks thereafter, their sentiment was completely, those gains were wiped out. So essentially, sentiment is little change for this top stock holding group. For other consumers, they're not really paying attention to day-to-day, week-to-week movements in the stock markets. It's really those with large portfolios, with high exposure to the stock market, who have been supported by strength in the stock market over the course of this year and appear to be responding to the weaknesses we've seen recently.
Joanne, really wonderful to get your thoughts this morning. Thank you for joining us. Joanne Shu of the University of Michigan. Let's get a check on markets because it is some extreme whiplash. After the huge moves of yesterday that rivaled that of April, it's slight gains, but we were just, again, 15 minutes ago looking at slight losses for the NASDAQ. Nvidia at this point also looking at losses, but that's been going back and forth. It's a hard market to get a handle of, Matt, right now. Maybe speaks to the fragility of the moment and the weak hands that are just trying to hold on to gains.
Yeah, it's interesting that the VIX is still at 25, right? So the stock market's fear gauge is still up right now as we look at this volatility, but it's not dragging down the broader indexes to losses. Let's get a look at some of the single stocks moving at this hour. The big volatility coming from Nvidia. We see it right now down 0.6% after the massive reversal yesterday, up 5% and then ending the day down 3%.
Okay, but just 7 minutes ago it was positive, so make of that what you will. By the way, crypto-linked stocks, not all of them are still falling. Marathon is up 0.5%. Strategy only down 1/3%. Bitcoin, some of its losses have ebbed. It's down 3%, but Matt, still below 85,000, on track for its worst monthly performance since 2022.
And the world's largest drug maker, Eli Lilly, just joined the $1 trillion club. The milestone, the market cap milestone, comes as investors bet big on the drug maker's weight loss medicines. They have Mounjaro, an oddly named weight loss and diabetes treatment, as well as Zepbound.
Yeah, doing well for them. Okay, coming up on the show, Marija Veitmane of State Street says, keep calm and keep buying tech. She joins us next. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Foxconn plans to invest as much as $5 billion to expand its U.S. manufacturing footprint, ramping up production to meet soaring demand from OpenAI and Nvidia. Chairman Young Liu spoke with Bloomberg Television about the move.
CapEx-wise, it's in maybe 1 to 5 billion to start with, 1 to 5 billion to start with, to build the factories, to build R&D centers, okay, but to build the working capital required to build a data center, that's totally different. That requires huge amount of money.
Yeah.
And with that, we are going to work with SoftBank.
President Trump will meet with New York City's incoming mayor, Zoran Mamdani, at the White House today. The Democratic Socialists campaigned on rent freezes, free buses, and higher taxes on the wealthy. So the populists. Trump has threatened to pull federal funds from the city under Mamdani's leadership, setting the stage for a high-stakes clash that could shape next year's midterms. But he's also a populist, so it'll be interesting to see what they have in common. Americans are passing more than just the stuffing this Thanksgiving as people swap booze for cannabis-infused seltzer, gummies, and even THC-laced gravy.
Surely not.
Legal marijuana sales hit $30 billion last year as alcohol consumption falls to levels not seen in decades. The day before Turkey Day, said to be the second biggest day of the year for legal U.S. cannabis sales, according to an industry group with some people dubbing it Green Wednesday.
It makes complete sense.
Yeah.
You want to eat more?
You want
that would help you, give you a little bit, make things taste a little bit better.
You want to deal with your family,
yeah,
right? You got to take the edge off a little bit. And in the past, it's been all about this,
right? And historically, after eating a ton of turkey and drinking a lot, you feel horrible the next day. This at least makes you only feel like you were, eating too much.
Less of a hangover and more of a food baby. Yeah.
All right, let's get a check on markets this morning. Are you still feeling a hangover from the destruction of yesterday? Man, it is some serious whiplash. Okay, we're still positive on the S&P. Now we're negative on the NASDAQ. Nvidia's down 1.6%. We literally showed you Nvidia before the commercial break, and it was positive, or at least it was closer to positive. It was only down 0.5%. Now it's down 1.5%. Marija Veitmane, State Street Global Markets Head of Research, says keep calm and buy tech. She writes, the bottom-up story in tech is the only game in town. IT remains our favorite sector in the U.S. and globally, despite high valuations and crowded positioning. Marija joins us now. Marija, can I just get your take on both yesterday's whiplash and today's volatility? What do you make of it?
Yeah, hello. Thanks for having me. We know that tech is expensive. We know it's very crowded, and we know it's November. So I think that's a kind of challenging mix as people try to protect profit. There is lots of uncertainty. Matt earlier mentioned VIX being at elevated level. So I think that's understandable. I think people want to protect portfolios. There are quite a lot of kind of risk aversion. What we tend to recommend clients is that when you're worried, when you concerned about sentiment, go and buy good quality stocks. So that's how we get all roads lead to tech. Those are better quality stocks. That's what people should be going to.
Marija, tell us again, we've talked about this before, but how you view this AI build-out relative to the fiber rollout that we saw in the early 2000s, late 90s, because, the internet was an important thing that changed the way we live, like a major technological advance that we all started using instantaneously. And yet, we just saw Cisco get back to the levels it fell from this week. It's taken 25 years for them to recover. So why is this time different?
Yeah, no, I mean, this time is different. There's probably three most dangerous words in financial markets. But I think fundamentally we point to two things. One is that the companies that building out kind of AI infrastructure are very, huge, very profitable, well-capitalized companies. So that's kind of question, kind of distinction number one. And outside, like a few companies like Oracle, we have quite a lot of kind of companies have a lot of free cash flow to spend on that. So they're very profitable companies. That's point number one. And second, probably equally important argument is that the compute they're building out, all this kind of investments, it's already pre-sold. So it's not like during the TMT bubble, the fiber optics were built out in the hope that internet will come and pets.com will come. Here we have a different situation. Here we have a lot of demand that for that compute that's already pre-sold, couple years out. So companies that doing the infrastructure investments, they're catching up. So demand is still higher than supply. So those two to us are kind of critical differences.
I mean, Marija, they are certainly bringing in a lot of cash, but that is being dwarfed by the commitments that they're making. This is the math done from BCA Research. That the hyperscalers will hold at least $2.5 trillion in AI assets by the end of the decade. If you assume a 20% annual depreciation, that would generate $500 billion in a depreciation expense. That is more than their combined profits for this year. Marija, as the spending continues, as you look further out, unless they're able to monetize AI, does the math get too complicated to make this sector and these specific players as attractive as they are to you right now?
Yeah, no, that's a fair point. And I think it's kind of important. And I think what market beginning to look at this stage is kind of this monetization issue, kind of show me the money argument, is that, and companies which have kind of easier to monetize that, so be that as a kind of infrastructure, cheap sales, or, I don't know, energy plays and companies that can monetize this AI boom easier, they tend to perform better. And I think that kind of big distinction between results, like market reaction to results of Google versus Meta, for example. When it's easier to monetize, when investors can see ways that companies can make money, kind of in a more straightforward way, results like big AI spend is kind of seen as favorable. When it's more challenging, then there are question marks. And to be frank, I think at this stage, the kind of maths on depreciation, total spend is still, have fairly wide assumptions around them. So it's more difficult. So I think looking at who can monetize, how they can monetize is an important driver of investment decision. Absolutely.
I wonder about value. We were teasing your view, State Street's look at value stocks, and your data shows the lowest holdings of value since the year 2000. So what is it that, re-rates value constantly, concretely? Is it rate cuts? Is it CapEx cycle broadening beyond AI and inflation surprise? What do we need to see?
Yeah, I have to say that this kind of data on investor positioning and value is quite shocking. In general, we know that there is value premium and cheaper stocks should outperform. They haven't done for about 20 years. And I think the reason for that is, now it's kind of fashionable to talk about K-shaped economy, or part of the economy, part of the stock market are extremely profitable, others are not. And I think that has been true for quite a while. The kind of growth was not broadly shared by a lot of companies. And that, to our mind, is kind of the reason why there are some extremely profitable companies. Think about kind of Nvidia the other day, margins are at 70%, and Gap today at margins are a couple percent. So I think that's the kind of distinction. And what investors were doing is that they were pushing for better fundamental companies with higher margin, higher profitability, pushing those valuations and not sharing it with companies with fundamental challenges. And that gap is still there. What is going to change? I think broadening of earnings, exactly what you said, Matt, is that you need to have broader earnings. You need to find sources of earnings growth somewhere else. Then you don't have to pay those expensive valuations for better companies for Mag 7. So then you can rotate. But realistically, is that the scenario we expect next year? Probably not.
No. All right. Hey,
so value would be a challenge.
Another bad year it could be for value. Marija, it's a good day for value today. They're doing well today if you look at FTW. Go. Marija Veitmane there of State Street. Really appreciate your intel. Still ahead, mixed reviews. Wait, mixed reviews? Awful commentary on the new all-electric Cayenne on social media. Some people say it's a soulless appliance. Others say, why don't I just buy a Chinese EV directly? A car that no Porsche enthusiast asked for. This is bad reaction. But to be fair, we're talking about social media, right? So that's the place you go for bad reaction.
Yeah, that's an important caveat.
More on this new Porsche next. This is Bloomberg Open Interest. Porsche unveiled its latest version of the Cayenne as an all-electric SUV, the EV version. The debut comes as the automakers are learning a hard lesson. Luxury EVs are not selling, and the interesting thing about this, to me, was the fact that it's gotten lambasted on social media. Bloomberg's Detroit bureau chief David Welch joins us to talk about a company whose stock has fallen or lost about half of its value since the IPO. David, and to me, this is so shocking because I grew up writing the most profitable car maker in the world whenever we would do a story about Porsche back in the day. And now it's losing a ton of money because of its EV investments, right?
Right. Look, everybody's having a tough time with this. You look at companies like Ford and General Motors, they lose money on every EV they make. They've reported that it's a big drag on their earnings. They make a lot of money because they sell big SUVs and pickup trucks that have huge margins on them. Porsche doesn't have that. They do have SUVs. They should be making good money, but they've put a lot of money into EVs because they want to be a player in China. Luxury buyers actually do like EVs. They're not selling in huge numbers in the U.S. because EVs are generally struggling here. But luxury buyers like to be on the forefront of technology. They like vehicles that are fast, quiet, and smooth. EVs do that. So they put a lot of investment there, and there's probably a lot of stranded capital that's hurting their financials.
It just seemed to me that the bad reaction on social media, almost like a Jaguar moment for Porsche. Do you think it's not quite that bad?
Well, look, let's go back to when Porsche decided they were going to make an SUV. Remember that reaction? Everyone's like, oh my God, Porsche can't sell SUVs. It's a sports car company. Had they listened to those people, they probably would be out of business now because they'd be selling a small number of sports cars to enthusiasts. That said, I read a lot of those comments, and I think what people were reacting to was the styling. And where I'd kind of agree with these people is, from 30 feet, 50 feet away, every mid-sized crossover SUV looks the same to me, too.
True. They're all jelly beans, and a lot of them starting to look very much like BYDs. David Welch runs our car coverage out of Detroit, Motor City. For all things autos, check out my podcast, Hot Pursuit. A new episode drops tonight. We welcome our Bloomberg television and radio audiences worldwide. I'm Matt Miller alongside Danny Berger. Joining us now is Amtrak President Roger Harris as the company posts record 2025. Talk to us first off about the year that was, and are more people, Roger, choosing the train because of the reliability problem of planes?
Hi, Matt. Good to be here today. Thank you. So let's talk about 2025. This is a great time to be here at Amtrak. I'm certainly very excited about it. We just had our record year in terms of ridership. We carried 34.5 million customers. And I think we did that by running a good railroad, focusing on things like on-time performance, cleanliness, customer service. That in turn generates really strong revenue, record ticket revenue of $2.7 billion. That allows us to invest in new product like the new trains, the new Acela trains that we launched in August of this year. Also, we have a new train coming out next year, the Aero trains, that will be seen first in the Pacific Northwest and then later in the Northeast Corridor. We're also investing in new routes, like the new Mardi Gras service between New Orleans and Mobile. Last year, we launched the Borealis service between the Twin Cities and Chicago. And we're also doing a ton of capital investment in infrastructure, things like bridges, tunnels, new maintenance facilities. In fact, we're spending $500 million a month on new capital investments.
Yeah. Hey, Roger, if I can just jump in, because I am someone who rides the Amtrak all the time, that Northeast corridor. I go from New York down to my home of where I grew up in D.C., where my family is very frequently. And I can say without a doubt that the experience on the Amtrak is way better than flying. The issue is that very, very frequently riding on the Amtrak, and not even the Acela, is much more expensive. The experience has gotten more expensive with the introduction of dynamic pricing that I myself, over the past couple weekends, have opted instead to fly because it's been significantly cheaper. Where is the tipping point
if your
for
flight
you?
Goes,
if your
right?
flight goes,
Come
that's
on.
a very important part. Thank you, Matt. A very important part to say. But okay, what is the tipping point for you where you see you can no longer continue to raise prices because people will opt for a cheaper option, be it driving themselves or a plane?
Yeah, well, this is a very good question, Danny. So, I mean, part of the dilemma we have is that there's so much interest in passenger rail these days across the country. We're seeing ridership surges in all areas, and it's supply and demand, right? If we lower the prices too much, then the trains fill up too soon, and there isn't a seat available for that last minute customer. But we see help on the way in terms of more capacity, because that's really the answer when you have a ton of demand like we do today. So the new Acela trains, which we're rolling out, have 27% more seats than the old generation Acelas. We are focusing very hard on rolling out those new Acelas. So we have 7 in service at the moment, and we're going to have 24 by the end of this coming year. And then the new fleet that rolls in as well will be additional capacity. So I think that's really the light at the end of the tunnel.
I have to say, and I told you about this before, Roger, I have a fantastic time on the Amtrak. I recently rode down to Richmond, and it was an incredibly refreshing and relaxing experience compared to the hustle and bustle of the airport, with my flights often getting canceled when I get there. However, it was incredibly slow. Like, I had all day, so it was no big deal. But I feel like I could have at some points walked faster. And I've lived a lot of my life in Germany, where the trains do a solid 200 miles an hour. Why are our trains, why is our technology so much slower than that of the rest of the developed world? Why don't we have high-speed rail?
Yeah. So, many of the trains we have can go faster than the infrastructure allows. And it's really about not only the rails, but also things like the electrical systems, the wires overhead that supply the electricity for the trains.
Right, but the Germans have figured this out. The French have figured this out. The Spanish have figured this out. Why can't Americans make fast trains?
Right. Well, we have to replace all that infrastructure in order to make the trains go faster, because that infrastructure I was telling you about is basically 100 years old, and trains didn't go that fast 100 years ago. So that's what we're working on. It takes a long time to do that, unfortunately.
Well, during the government shutdown, Roger, I'm sure this doesn't help. President Trump said that he had terminated $16 billion in federal funding for a new tunnel on the Northeast corridor. Would you like to see more aid, more funding coming from this Trump administration, Roger?
In general, we've seen the funding come through every month on the big projects that we're working on. So I think that the challenge at hand is really to kind of buckle down and get the projects done that we're already working on.
So I wonder about, especially around here, Roger, we care so much about the New York area, and the Hudson Tunnel project is going to be scrapped under the Trump administration, too, canceling funding for that. How does that affect the Northeast corridor and its most congested area?
So we're still working through that, and I think that work goes on every day while there's money available. So I think the most important thing is to not have these projects get interrupted, because that's when things start to cost a lot more money. On the east side of Manhattan, we're working on rehabilitating East River tunnels. We're going to have the first one back in service next July. So those are the things that we're focusing on right now.
Roger, when it comes to leadership, obviously you are there at the helm of Amtrak, but Stephen Gardner was asked to resign as CEO just 2 months into the Trump administration. Are there any plans to replace him? And how is your relationship currently with the White House, given some of that back and forth to start his term?
Well, it's a question I get frequently. I come to work every day knowing that there could be further changes, but so far, I think we've been working very well with the administration, doing the things that we have in common. We want to run a great railroad. We want to get this infrastructure built. And if you've traveled west out of Manhattan recently, you've seen the Portal North Bridge that's grown up out of the marsh almost, and we're going to have the first trains operating on that span with our partners, New Jersey Transit, shortly after the new year. So there's real tangible evidence of this investment in infrastructure.
I got to ask about New Jersey Transit. It's the bane of many people's existence, right? I think intelligently chose Westchester as a place to live. And Metro North is awesome and always working and very often on time. Whereas New Jersey Transit, like, we write stories on a weekly basis about how bad it is, the delays, the stoppage in tunnels. Why is that such a problem compared to riding up and down from Westchester? Why is crossing over the river into New Jersey so much more painful for commuters?
Well, I think that one of the problems is that going west, we only have 2 tubes under the Hudson, whereas there's a lot more capacity coming into Grand Central Station for Metro North, and even from the east, there are 4 tunnels under the East River. But I would say this, that all railroads have a really hard time every day facing the reality of old infrastructure and the reality of the operation. And I think there's plenty of challenges to go around.
Got to invest in that infrastructure.
Got to invest in infrastructure. Roger, thank you so much for joining us. That's Roger Harris of Amtrak. Now let's get you a check on the markets, because Nvidia, it is plunging down. I think we can say plunging, right? It's down more than 3.5% after opening higher and trading higher for the first 30 minutes of the trading day. A real sell-off has gained some steam. You can see that there, the back and forth and the whiplash that we've seen. That means that this overall market has now turned negative. It is down 0.1% for the S&P. The NASDAQ, because of that, underperforms, down 0.6%. By the way, there was some reporting from the information overnight of Sam Altman warning staff of rough vibes and a potential revenue growth collapse of to 5% as it tries to catch up with Google. So there's some real tension now, also with these other link stocks, as the competition from Google starts to rise.
All right, so Nvidia dragging down the rest of the market right now after an incredible reversal yesterday, an 8% swing, right? It was up 5% in the morning and then dropped 3% by the close. Today, it is dragging everything down as well. Let's get a look at some of the other single stock stories moving this hour. The Gap, noticeably smaller than Nvidia.
Just a tiny bit.
Reported stronger than expected sales thanks to celebrity collaborations. Apparently, Apple and Gwyneth Paltrow have a collab there.
Apple, her daughter, not the iPhone company. Ross stores that are also rising. They had new marketing campaign, so I guess kind of a similar thing, but they're a discount retailer which has been doing well. They said that tariff-related costs will be negligible in the fourth quarter, so those shares up more than 6%.
And another gainer, Intuit delivered positive results with the CFO citing AI demand from mid-sized businesses. So maybe AI will be driving cash flow at the tax preparer.
Coming up, I know what I'm doing with my day tomorrow. Kicks off the Las Vegas Grand Prix. Wall Street Week explores how Zach Brown turned McLaren into a Formula One winner. That conversation coming up next. This is Bloomberg Open Interest.
Time now for our Wall Street Week conversation. Under the leadership of Zach Brown, McLaren placed first in the Formula One Constructors Championship last year, a first for the team in more than 2 decades. David Weston speaks with Zach Brown about the team's rise back to the top.
Brown is one of the highest paid executives in Formula One, taking home $50 million last year, a reward for an executive who has returned one of motorsport's most storied teams to the top of Formula One.
It almost feels harder because now we're at the top of the mountain. There's only one way to go, and this is sport, right? That terrifies me. And that's why I get up every day. It's like, I know the storm is coming, but I want to kind of keep pushing it back as much as possible and just keep doing what we're doing.
Zach Brown wasn't born into this world, and growing up in California, he might not have seemed like the type who would go on to run a multi-billion-dollar Formula One team.
I was a bit of the troublemaker, was a bit of the class clown. I did get an A in baseball and in work experience, which were my 2 loves. Had there been a racing class, I'm sure I would have done well. But history, science, math, just not that exciting for me.
Brown's path to racing wasn't the usual one, if there is such a thing. It all started on a 1984 appearance on Wheel of Fortune.
Zach, $3,050. Identify this person.
Wild Bill Hickok.
Yeah, that's it.
And the deal-making followed.
So I asked Mario Andretti, how do you get started in racing? He said karting, and there happened to be an ad in the race program for Jim Hall Kart Racing School. I'd previously been on Wheel of Fortune Teen Week when I was 13 years old. I won. That was back in the day where you won prizes. So I had this stash of his and her watches. What am I going to do with these things? So I went and sold them at a pawn shop in Van Nuys, took that money, bought a go-kart, and got started racing in karting. And then it was kind of school of hard knocks. I didn't know how do you advance. My mom being a travel agent, she found someone at TWA Airlines who was passionate about racing. They gave me some airline tickets. I'd go sell those airline tickets to pay for racing, and that's kind of how the racing career got started.
If you're really going to go motor racing, you need some financial support from someplace. Now, some people have wealthy parents or wealthy backers and things like that. You didn't necessarily have that. Your parents were much more middle class. So how did you afford it?
So I started to learn how to do sponsorship. I remember my mom and dad kind of talking about how they could help me, and so my mom gave me her salary for a year, which was about $30,000, $40,000, a lot of money, but in the big scheme of things from racing, you know, there's families that have spent millions and tens of millions, so it was kind of enough to get me started, but not even for a full season. So I didn't know anything about sponsorship, but I got fully immersed in how does sponsorship work, and really it trained me to this day, which was I needed to understand what companies wanted to do with their business and how I could use motor racing to help them achieve their goals, something that I still have with me to this day.
David Weston speaking with McLaren Racing CEO Zach Brown. You can catch Wall Street Week tonight and every Friday at 6 p.m. New York time. I got to say, the reason that it's so wonderful that McLaren is doing well, not just because McLaren is a great company, but the fact it means that there's actually competition in F1 at the top. It's not just like Red Bull and Max Verstappen getting away with every race, which he did the past few races. But it's good to see actual motorsport having some back and forth and some real question as to who will win.
That's right. I mean, you want to see, but the thing is, if you want to see competition and if you want to see passing, if you want to see different winners,
are you going to say you need to watch MotoGP?
You have to watch MotoGP. Because in F1, like where you qualify oftentimes is where you finish.
Not always.
The cars are so wide, the tracks are so narrow, they can't really do a lot of wheel to wheel.
Yeah, but when they do, it can be spectacular and scary, but incredible.
Highly recommend MotoGP.
Okay.
Highly.
Fair enough. Coming up on the show, from central banks to the complex world of AI, Greg Calnon of Goldman Sachs Asset Management will be discussing the factors shaping global markets in the year ahead, a conversation you don't want to miss. This is Bloomberg Open Interest. Goldman Sachs Asset Management has launched its 2026 outlook as we approach the end of the year, writing central bank actions, a new trade order, fiscal risks, geopolitical shifts, and AI are creating a complex yet dynamic investment backdrop. Dynamic It certainly has been. Joining us now is Greg Calnon, Goldman Sachs Asset Management Global Co-Head of Public Investing. Greg, thank you so much for joining. I mean, I don't even know how you begin to think about 2026, where the end of 2025 has been already so volatile and confusing. I got to ask, this past week of really questioning the AI narrative, the sustainability of the trade, has it made you rethink in just how 2026 will play out when it comes to that sector in public markets?
Well, the last 2 weeks certainly creates a pretty complex backdrop for where we're headed for 2026. So that's something that we factor in. And that complexity is creating a lot of uncertainty in markets, as we're seeing today with a lot of the different dispersion across equities. That complexity is ultimately really good. That uncertainty is ultimately really good for active investors like us because it creates a lot of opportunity. So we haven't re-underwritten our outlook as a result of it. We think that there's a tremendous amount of opportunity going forward into the new year. I'd say there's three key parts of our outlook that we're focused on. One is we think that the macro backdrop does lend itself well to having a good year for risk assets again.
Because it's a strong economy?
It's a strong economy. You also, we believe, are going to have central bank cuts, right? And so that's also helpful. And corporate earnings remain strong, right? And so when you have those three things put together, as much as we have so much complexity around the world, you try to simplify it as much as you possibly can. You boil it down into those three factors, and those are good things for equity markets in particular.
So those are the main three factors that you're focused on: a strong economy, Fed, an accommodative Fed, and corporate earnings that continue to be like double-digit growth, beating expectations by 5+%.
Yeah, those are the three factors. We're not expecting double-digit corporate earnings growth again. We're probably more like high single digits. So coming off a little bit from what we've had throughout this year, I would say. But yeah, we think good macro backdrop, good for equities. We do think it's important with central bank cuts to have a little bit more income in the portfolio, and income in a couple of different ways, which we can talk about. And then the third thing that I would say is, it's important to be diversified. It's important to have downside protection. So all of this backdrop that we're talking about, all of this uncertainty, you can't just put it in equities and let it ride. You have to make sure that you have
how do you get?
Yeah, I was going to, because on a day like yesterday, the Russell fell, the equal-weighted S&P 500 fell. It felt that any sort of downside protection, diversification did pretty poorly yesterday.
Well, thankfully, there's more asset classes than just equities, and so that's one benefit, right?
Wait, but can I ask that?
Sure.
Can you not hedge through equities right now, just given how ubiquitous the AI trade has become?
You can diversify through equities, certainly, right? So having a higher allocation to developed markets, meaning outside of the U.S. I was just in Europe. I got back last night. There's a lot of enthusiasm for Europe. There's a lot of enthusiasm for what's going on in Japan and new administration there and fiscal expansion. So I think those are two markets, if you look, have done, up 25% this year. S&P's up, what is it now, 11%, right? So that's another good opportunity. I wouldn't necessarily say it's a hedge on equities, but it's good to diversify out of just the AI trade in the U.S., right? And so that's a theme that we've been talking about for some time now, is sort of broadening of equity markets. It's not just about the S&P 500, and that's come through this year.
Can I just ask, I note that your title is Global Co-Head of Public Investing at GSAM, and we have been shifting our focus, as has everyone lately, to really include the private markets.
We've had a lot of your private market colleagues on as well.
Yeah, absolutely. And they've stumbled as of late. Well, just the past few days, it's gotten a little bit more dramatic for them. Do you expect investors to continue diversifying into private assets, or do you think that maybe they shift back?
No, I mean, look, I think there's tons of opportunities in private markets, and that will continue. When you think about an entire portfolio, the majority of it is in public assets, but you can get a lot of incremental return. You can get other diversifying benefits from being in private markets. And I think that trend will certainly continue. There's a lot of focus on private credit right now. We think those are mostly idiosyncratic issues, but really it comes down to underwriting. And if you have an organization like we believe we are that does good underwriting, then you'll be just fine.
Just only less than a minute here, Greg, but to your outlook, how important is it that we do get Fed rate cuts, at least starting next month?
I don't think it depends upon Fed rate cuts, but I do think that that's helpful for the overall setup of risk assets, right? Look, if we don't get Fed rate cuts because of inflation, that's probably bad. If we don't get Fed rate cuts because the economy's accelerating at a faster pace than we realize and the job market remains strong, I think that that's fine for equities. But look, I think the good news in all of this is that for individual investors, for their advisors, there's more tools than ever to be able to navigate through these complicated markets with new ETFs, buffer type strategies, other diversifying liquid alternatives. There's a ton of tools that really haven't been available over the last 5 years that are now available to investors.
All right, I want to talk to you about all that stuff.
Sure.
We're out of time right now. So I hope you can come back
I'd love to
and
come
join
back.
us, because that's a can of worms that I want to open up.
I'd be delighted to open it with you.
All right, Greg Calnon of Goldman Sachs Asset Management, thank you very much for coming in. Coming up on Monday, Lori Calvasina joins us from RBC, Caterina Simonetti from Morgan Stanley, and Trip CEO Olivia Faherty. This is Bloomberg Open Interest. Tech starts next.